is a trademark used by Thrivent Trust Company and Thrivent Trust Company of Tennessee, Incorporated, separate affiliated entities. Now back to Talking Money.
We've got about 11 and a half minutes here left in Talking Money. If you got a question, call it now, 877-235-9405. Or you can always text us that question. Karen had a question that just said something about the Putin and the Russia and so forth. I didn't quite sure what the question was, but I would encourage you to go back. It's very, very helpful. Back a few weeks ago, I interviewed Mark Elam, our senior investment strategist down at in our national office. And one of the things we talked about during that program was Russia and the invasion and how that affects what should you do and that kind of thing. So I encourage you to go back to talkingmoneyradio.com and go to Listen Now. And when you go to the Listen Now button, then you can go to other programs that we've recorded that are listed there. You can search by topic if you want to, but this one just a few weeks ago, so it'll show up on the first or second page. And just click on that and listen to it as a podcast, and however you listen to podcasts, and you'll be good to go. So a lot of great information there as well. So we've been talking about investments and getting some of the basics of investments down last week and this week, and talking about stocks versus bonds and so forth. And before the break, I was talking about the major asset class performance. So we've got this chart that shows different classes, and I mentioned them before the break. So there's a lot of different ways to track this. This particular one just tracks U.S. large cap, which would be growth and value stocks, international developed stocks, emerging markets, gold, bonds, commodities, which is just general commodity index, and inflation. And some of these, by the way, these slide decks, some of these that I have, if you want to copy some of these slide decks, I think you can go on the ronblue.com website and pull these up. This is as of 12/31/21, and so they'll get updated each quarter as more reports come out. But this comes from our ISG group down in Atlanta, but it's approved for general distribution. So some of these I can send right out to you if you want. Just send your email or just send an email, and then of course have your email address to the Mike at talkingmoneyradio.com, and just say you want the PowerPoint presentation, or if you want a particular slide that I talked about, then we can just email that to you, and you can have it to your heart's content. But this one looks at those particular items. And what's interesting about this chart, I think it's one of the best educational charts that you can look at, because it helps keep you in perspective on when to invest in something and when not to invest in something. So if I go back to 2008, the list of investments, bonds, that was not a good year for stocks. Remember the Great Recession, but bonds, the bond index was up 5.2%. Gold was up 3.9%. Inflation was essentially zero that year. Commodities were down 35.6%, the commodity index. U.S. large cap stocks were down 37%. In total, of course, a lot of these things went down more because when you take the first couple months of 2009, then they went down even more than this. But this is for the calendar year 2008. International developed stocks were down 43. Emerging markets were down 53. So the natural inclination, I think, is to look at that and say all three of those, large cap, international developed, and emerging markets, so this is crazy. Why am I investing in that? I'm just going to get out because I can't take it anymore. All right, so what happens if you did that? So the next year, 2009, remember, emerging markets was down 53.2% in 2008. 2009, it was back up 79%, which probably didn't quite make up for the 53.2, but boy, it sure did make a good stab at it. And if you just bailed out, you lost all that. And you never have a chance to get that back, not in that rate, because it's going to be a different year and different performance after that. The second best performing in 2009 was international developed stocks, which was the second worst the year before. And then commodities were next, and then U.S. large cap stocks were up 15% for the year. And if you took certain stocks, they were up even more. When I mentioned 30%, I mean, stocks were up a good bit. A different index than that was certainly up higher than that. And I remember our portfolios did really well. The stock part did really well that year. But that goes back a long time ago. What have you done for me lately? So it's just a good reminder, like, just because something's down now, if it's a good investment, you got to be thinking, well, should I really be investing more in that? As hard as that is, because I know it's very hard to do that. It's easy to look back at a chart like this and say, oh, okay, I'll do that, because you can see what it did the next year. But when you're in the middle of it, It doesn't feel that way. It doesn't feel like it's a good thing to do. So fast forward to 2018, which is not the most recent year when stocks really did not perform well. So you had international developed stocks were down 13.4, emerging stocks were down 14, and U.S. large cap stocks were only down 4.4%. Well, the next year, in 2019, U.S. large caps came roaring back. After 5.4, they were up 31.5. International developed stocks were up 22, and emerging markets were up 18.9. So you see that volatility in there. So that's the risk, I think, that is in different types of stocks, is that risk of volatility. And the feeling that, and this is natural to do, that when stocks are going down, we tend to think that it's going to keep doing whatever it's been doing lately. So we feel like it's going to keep on going down. That's just human nature, I think. The same thing happens in reverse. And when people start getting greedy, stocks have been going up, going up, going up. We think that's what's going to keep doing, going up. Well, it's not going to do either one of them consistently.